Welcome to this explainer. Okay, so if you're stepping into the financial world as a first-time borrower, you've probably noticed right away that there are these sort of invisible rules governing what you can and absolutely cannot do. Well, today, we're going to decode exactly that. We're diving into what is essentially the ultimate game manual for building and maintaining your financial reputation.
Have you ever actually wondered why that happens? You know, why some people can just walk into a bank or click a few buttons online and get a loan approved instantly, while others just get a swift, hard rejection? It's all decided by an invisible financial gatekeeper. Honestly, it can feel a bit like dealing with a really strict nightclub bouncer who just flat out refuses to tell you the dress code. But actually, it's highly systematic. And one of the biggest reasons behind those instant approvals or rejections is just a simple 3-digit number.
So here's our roadmap for today. First, we'll meet your financial gatekeeper. Second, the core 4 factors. Third, we'll cover essential tips for first-time borrowers. And finally, we'll be busting some common credit myths.
Let's jump right into part 1, meet your financial gatekeeper. It's time to understand the objective of the game.
So what is a credit score? Basically, it's a number that represents exactly how responsibly you've managed credit in the past. If you want to think about it narratively, it's kind of like your adulting GPA. It's your ultimate financial reputation. Lenders look at this exact score when they're deciding whether to approve a loan or credit card application. It's really just a quick, mathematical summary of your financial trustworthiness. You know how a report card tells a teacher how you've been doing in a class? Well, this score tells lenders exactly how you've been doing with borrowed money.
In many countries, it really just boils down to this basic comparison. A high credit score generally means lower lending risk, and a low credit score, that generally means a higher lending risk. If you have a high score, lenders look at you and they see a safe bet. And that safe bet status, that's what unlocks those loan approvals and secures you much better interest rates. On the flip side, a lower score is literally a giant, flashing danger signal to them. It makes it way harder to get approved, and honestly, significantly more expensive if you actually do.
All right, moving on to part 2, the core 4 factors. Let's demystify how this scoring system actually works.
Think of these 4 factors as the key ingredients to your score. The absolute most important ingredient is your payment history. Paying your bills on time is your foundation. Without that, everything else just kind of falls apart. Next up is credit utilization. Look, just because you have a high limit doesn't mean you should max it out, right? Then you mix in the length of your credit history, because having a longer, well-managed track record builds a lot of trust. And finally, you got to be cautious with new credit applications. All of these ingredients interact together to create your total financial profile.
Let's look a little closer at that 4th ingredient, because man, applying for too much too fast is such a common trap. Imagine you're a lender, okay, and someone suddenly asks you and like 5 of your friends to borrow money all in the exact same week. You'd probably wonder if they were in some serious financial trouble, wouldn't you? Well, it's the exact same thing with credit. Applying for 5 credit cards in a week just signals panic to a lender. It makes you look desperate for funds, which directly hurts your new credit applications factor and drives your score right down.
Let's pivot to part 3, tips for first-time borrowers. These are the crucial beginner strategies you need to succeed.
This right here is the ultimate beginner's playbook for establishing a pristine financial reputation straight out of the gate. But look, figuring out how to build your score from scratch can feel incredibly frustrating. It's a total paradox. You need credit to get a good credit score, but you need a good credit score to actually get credit. Don't worry though, there is a clear way through this maze. And it's so important to figure it out, because demonstrating responsible borrowing habits early on is what helps you qualify for loans way more easily and get those better interest rates from day one.
So to build that pristine reputation, you really need to play both offense and defense. Your best defense? Prioritize paying bills on time and absolutely avoid missing payments. Consistency here is what protects your entire foundation. And your offense? Keep your credit card balances low relative to your limit. And seriously, only apply for new credit when it is genuinely necessary. Finally, you need to audit yourself. Regularly review your credit information wherever it's available to you so you always know exactly where you stand. Policies do vary by country, for sure, but if you master this basic offense and defense, you are setting yourself up for long-term success. Finally, let's wrap up with part 4, busting common credit myths. Let's help you avoid those classic rookie traps.
Millions of beginners are absolutely terrified to even look at their own financial reputation because of this one widespread myth, that checking your own score always lowers it. But the reality? It totally depends on the type of inquiry and the country you're in. Usually, a personal check, what's often called a soft inquiry, doesn't penalize you at all. It's the hard inquiries from lenders when you're formally applying for new credit that can cause a temporary dip. So staying informed and checking your own score usually perfectly safe.
Okay, here is another huge myth that can literally cost you a lot of money. The idea that you need to carry credit card debt, like not paying off your full balance, just to build a good score. This is incredibly misleading. The reality is the exact opposite. Responsible use and timely payments matter far, far more than carrying a balance. You absolutely do not need to go into unnecessary debt just to prove you're a good borrower. Paying your balance in full and on time is the ultimate proof of responsibility.
Ultimately, your credit score is one of the most vital components of your entire personal finance journey. Understanding the mechanics of how it works is what actually allows you to make smarter, more strategic decisions for your future. Now, building a good score doesn't happen overnight. It really takes a great deal of time and consistency. So I want to leave you with this one final thought. When the time comes, what will your credit score say about you? Will it say you're organized, responsible, and a totally safe bet? By applying these beginner strategies we covered today, you actually get to write that narrative yourself. Thanks for joining me for this explainer, and good luck building that financial reputation.